सर्वेषु जाग्रति कामं 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 शो निर्विमानः तदेव शुक्लं तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शतः सर्वे तदुनात्ययितश्च नान्यकृतश्च एतद्वैता
I request Shreyans to please introduce the speaker.
Good morning, members. It is my privilege to introduce our today's learned speaker, our CA Gautam Nayak. He is in practice as a CA since 1986. He is partner of the firm C&K and Associates LLP. He is the president of the prestigious Bombay Chartered Accountant Society in 2004-05, editor and joint editor of the monthly BCA journal from 2005 to 2010. Was a member of the editorial board of the BCA journal from 2003 and is still a member until date. Member of the managing committee of IMC Chamber of Commerce and Industry in 2023-24. Chairman of non-profit organization committee of IMC Chamber of Commerce and Industry. Co-chairman of direct taxation committee of IMC Chamber from July 2013 to June 2020 and from July 24 till date. Member of the finance and investment committee of IMC Chamber. Chairman of the taxation committee of BCAS from 2011 to 2014. Chairman of the International Taxation Committee of BCAS from 2014 to 2017. Also, he has published many books, co-authored many books on various topics like transactions in shares and securities, taxation and accounting, taxation of charitable trust with BCAS, with ICAI, with and such other institutions. He has contributed to many articles and columns, including BCA Journal, and various newspapers and publications like Economic Times, Outlook, Outlook Money, and Open. He has spoken and written papers on various, including done seminars and conferences on with various professional bodies and corporates. He has appeared on CNBC, CNN and Bloomberg as a panelist on various panel discussions on taxation and audit. With this, I request all the members to extend a warm welcome to our today's speaker. I request CA Vishal Joshi to offer memento. And BCS will contribute rupees 500 on this behalf to CA Benevolent Fund. With this, I request our today's speaker to take the charge of the session.
A very good morning to all of you. It's good to see members interested in the subjects of taxation on a rainy Sunday morning when you'd rather sit at home and eat some hot bhajiyas, etc. But I think that shows the thirst of members for knowledge. It's something which all of us have been throughout our careers. I think that's the way we chartered accounts for. So it's a pleasure, as I said, to be with all of you today. The subject is on capital gains on securities, and capital gains on securities is a very vast subject because the very topic of security itself, the subject, what is security? There are various types of security, and therefore I was, I said, let me not restrict myself only to shares. Let me cover the whole gamut, and let me see what topics, which we come across in our regular, on a day-to-day basis. So let's look at that. That was the whole objective. So first let's look at shares. As you know, from 23rd July 2024, we have an amendment saying that one is that your rate of tax on short-term capital gains on listed shares sold on the stock exchange, that rate, which was 15%, has gone up to 20%. So far as long-term capital gains is concerned, the rate which was 10% has gone up to 12.5%. Again, of course, both these are without indexation. There is an exemption for long-term capital gains, which was 1 lakh. That limit has been increased to 1.25 lakh. So this is so far as, of course, all other long-term capital gains also, not just on listed shares, unlisted shares also, the rate of this has come down from 20%, it's come down to 12.5%. So 20% with the exception, come down to 12.5%. The exception which has been made is only for property acquired, immovable property acquired before 23rd July 24. Now that obviously does not apply to unlisted shares, etc., or unlisted securities. That the rate will of 12.5%, so no indexation will be available if it is the transaction is 23rd July 2024 or thereafter. So that is the change that we made. A couple of questions which come up and on this. One is that today if I have a loss which I've incurred in the second half where it is at 12.5%, and I have a rate of 10% gains for the earlier period up to 22nd July 24. Can I set off this loss against that gain? Yes, because ultimately what you're doing is you're computing under the head capital gains. Under the head capital gains, if what you can do is long-term loss you can set off against long-term gains, short-term loss you can set off against both short-term gains as well as long-term gains. So therefore, under Section 70, that set off is something which is clearly permissible. And it's only when you have something left over that you can come to the computation part of it. So therefore, that is not a problem at all. And there is a tribunal decision recently this was confirmed that was in the context of a loss at 15%, at 10% loss on listed shares, which was set off against a 20% gain on sale of immovable property. And there the tribunal said that yes, this is something which is clearly permissible. You can do that set off. The second issue is whether 1,25,000 applies only for the gains after 23rd July 24. What about if my entire gains is prior to 22nd July, up to 22nd July 24? Can I get the benefit of that 1,25,000? I think in this situation, possibly your gains, your gain exemption will be restricted to 1 lakh if you have only gained up to 22nd July. If you have some gains after 22nd July, then that additional 25,000 benefit can be claimed, is the way I would look at it. Of course, there could be various permutations and combinations. You can have loss in one and gain in the other, etc. How does it work? What happens, etc. But I think the broad message is that this 1,25,000 would apply to gains after that date. That's the whole. But I think one of the things is, of course, this has its own complications. And I suspect that one of the reasons why the utilities have not come out this year for forms 2 and 3 and is because of this capital gain competition. Because they're still trying to figure out. And again, the other complication is the rebate. Because as you know, the Chamber of Tax Consultants has challenged this before Bombay High Court, and Bombay High Court said that no, you can't deny the return filing itself. So your return filing has to enable, you have to permit the person to claim. Then how you process it, how you do this is a matter of, a debate or something which is a separate issue. So therefore, they're still struggling as to, so the problem is the law is so complicated that they now have to figure out how to make the return form, the utilities. So that is the whole problem, and which I think it's not something which, it shows that the amount of complexity that we have to deal with, on a regular basis. But I think all of us, we need to think what is the legal position, how can one achieve that? And sometimes I always say that, we've always talked about the law and practice of income tax. And today the practice of income tax is more of trying to figure out how you can fill the utility to claim the benefit that you are legally entitled to. So that is the real problem that one faces in real life practice. Coming to another important issue, and today we find that a large number of investors are making investments through portfolio managers. So typically, a portfolio manager, sometimes some portfolio manager will say that I will charge you 1% of the value of your corpus, and there is a hurdle rate of 10%. If you earn anything more than 10%, I will take 20% of that incremental gains is what will be. So that's the way that they look at. So sometimes it's a very sizable amount of portfolio management fees that particular high net worth individual pay. And the question then is it deductible? How is it deductible, etc.? What is the business? So you have, the way I look at it is, again, so what are you paying portfolio management fees for? What are the streams of income which could possibly come from a portfolio manager? One is, of course, dividends. The second, what you will be, and as you know, portfolio management, it's as if you yourself have earned that income. It's all that a manager is managing it for you, but it's all in your name itself. So that income has to be shown. It's unlike a mutual fund where it's not a pass-through sort of thing where you actually work out, on the units rather than on the underlying assets or what is the income. So in a portfolio management scheme, therefore, you have a stream of income of dividend which comes to you directly. The second category of income which typically would come to you in a portfolio management scheme would be capital gains. It could be long-term gains, it could be short-term gains. And perhaps sometimes if there are also debt instruments, you could have interest income. There may be, of course, other incomes which are through AIFs, etc. The portfolio manager may invest in some AIFs, etc. It will give some return, and which again, AIF being a pass-through instrument, that also gives you either dividend or capital gains or interest income. So these are the three broad streams of income that you get. Now, are portfolio management fees deductible is the question which will come, and how can you claim it as a deduction? Here, and again, the question then is, how do you bifurcate the portfolio management fees is a question which often arises. And here we have this, one thing which you need to keep in mind is that the that some rational basis is what you allocate. Now, typically, what the thing is, if you look at the sources of income, typically dividends would constitute maybe 5%, 10% of your overall income. More of it would come by way of capital gains, and therefore you should spell out the rationale saying that this is the basis on which I have bifurcated between dividend. Now, whatever is against dividend, obviously you cannot claim. Against short-term capital gain and long-term capital gains, can you claim it? And there the question is, what are you paying the portfolio manager for? What is he advising you on? He's advising you either buy the shares, he's advising you to hold the shares, or he's advising you to sell the shares. Correct? So therefore, in a sense, what he's doing is either it is, if he's advising you to buy the shares, and it is something which before you bought the shares, you are bound to pay to him, you entered into a contract with him. So therefore, it is at cost of acquisition if it is in connection with buy. If it is in connection with sell, it is expensive in connection with transfer. So I would say that so far as holding is concerned, what he is advising you to do is saying that when do you sell? He is advising you, that is the logic. And therefore, it is either cost of acquisition or it is an expense in connection with transfer. Today, it doesn't make a difference whether you claim it either as cost of acquisition or expense in connection with transfer, because of the fact that there is no indexation available. So if it is, so that is the this. So, but however, let me tell you that this is something which has been a subject matter of debate. There is one Gujarat High Court decision, but which is in the context of consultancy charges. Again, there will be somebody, you may be paying consultancy charges. A lot of people have. So you don't pay a portfolio manager, but you handle it yourself, and you pay a portfolio. You pay a consultant who advises you. Now, consultancy fees are, of course, this was in the context of a company which was carrying on business otherwise, and they said it's allowable under 37(1) is the way that they looked at it. But the question is, you could also take a stand that this is really expense in connection with transfer or it is cost of acquisition. In either situation, it should be allowed. So there are a number of tribunal decisions which have held in favor, but there are equally a large number of tribunal decisions which have held against. Let me tell you that this is one area where the debate has been going on now for almost 15 years, since 2010, 2011. I think we've seen these cases going on, and the Bombay trial, I've listed out some of those decisions over here, and which you can refer to. So the latest one, of course, is Narendra Desai, and where Virit Investments, Delhi Tribunal. So this is something which, if it is large enough, it may be worthwhile claiming it as an expense in connection with transfer or a cost of acquisition. But it's something which I think the client needs to understand that yes, this is something which could be subject to litigation. It is something which, now it's unfortunate that, the way that the government is looking at it is, the department may just say that no, it's not allowable as a deduction if you are asked for clarification. But one would have to wait and see High Courts, once this issue comes up before the High Court. So therefore, this may be then taken. One will have to look at it and see whether this will be allowed as a deduction.
Can I business income instead of capital?
See, if you're carrying on share trading activities, certainly it is fully deductible. There is no doubt. But business income, what you need to remember is you have to deduct TDS. Because in this situation, it will be 194C in that situation, so you'll have to deduct TDS is what will the position so far as. So business income, you have a very strong case, there is no doubt that it is deductible. The problem is if you are carrying on, you're having capital gains, and which is for most high net worth individuals, I think that is the problem, that you have capital gains and that's the position. And that is where I think the difficulty does arise. So,
in any case, if you are paying a more than 50 lakhs fees, then 194M.
194M also is something that you need to do. Yes. Yes, 194M is also which. Well, in most cases, it's typically between 5 lakhs to 25-30 lakhs is most the thing is what we've seen. And that's where 194M is, yes, we need to keep in mind. That's also something.
Sir, I need to bifurcate into the realized part as well as unrealized. Because
yeah, so see, I'll tell you what, I just to give you an example. For instance, if he's charging say X amount on the fixed thing, and say you've got a 10% hurdle rate and 20% over and above 10% is what they will take. So what I will do is for whatever shares I have sold, I will calculate. So it will not be whatever actually I have paid during the year. I may have paid part of it in the earlier year, I may have part of it this year. So the way I would look at it is I will calculate for each share which I have sold, what is the capital gain, how much is the 10% rate it works out to, how much is the additional 20%. So on the, I will calculate 1% plus I will calculate what is the proportionate thing. So there I think you are on a much stronger footing because you are calculating actually what you have paid in respect to that particular transaction. So that's the way I would look. Again, there is another nuance to it. You might have gone into the portfolio manager with your existing shares. And so what you have to calculate is also there when you're calculating from that point onward what was the value. You can't take your original cost and this thing. So when you're calculating the attributable PMS fees. So it's a question of how do you work it out so that it reflects the realistic or PMS fee that you paid in respect of that particular transaction. So therefore, if you're able to demonstrate that you have done it in a very scientific manner, which matches with how the portfolio manager has charged it, I think this is a good case for allowability. That's the.
Gautam, if I am a custodian and AD banker, if my client wants money to be remitted outside India, I am a custodian and I want 15 CACB. So by making 15 CACB, should I allow clients to claim this deduction of these expenses?
See, the question is, as I said, that this is something which the income tax department clearly is disputing. Do you want to take a situation where you certify something which is, could be debatable, is the question that you need to ask. And what is the risk involved? So as a chartered accountant, and also the foreign client, are they satisfied with saying that, okay, forget it, let me just, not claim that? And so therefore, I think this is a discussion which one has to have with every client. Understand what is their risk appetite. There are many clients who say, no, forget it, I don't want to claim this and get into litigation. Because, many clients are high net worth individuals particularly, they are focused on their business or they're focused on their, I have seen clients who say that, he's paid almost 3 or 4 crores saying that I don't want litigation at all. I would rather focus on my business, that money I will earn much more in my business rather than, So that's the thing that, so you have to look at what is the client's, ultimately it's the client who has to decide. You have to point out that this is disputable. Then you need to look at how you can protect yourself if you are issuing a 15 CD. So that's the way I look at it. Okay, so any other questions? We can take questions as we go. As I said, because there are many issues, there are many problems, there are, practical risks. So let's look at the next the thing is on interest expenses. So very often, the transactions and shares may be funded by out of a loan which is taken. So typically, the loan is, there are people who take loans and high net worth individuals who apply for IPO in the ICAI category. They pay interest. As soon as the shares are allotted, they will sell the shares and pay off the loan. That's the thing that they. So question here is, now, is this interest deductible? You have, as I said, the amendment under section 57. So far as against interest is deductible under section 57. However, it is the expression to section 57 says that it shall be restricted to 20% of the amount of dividends that is earned. So for dividends as well as mutual funds, this limit applies, this 20%. So whatever is actually earned. Now the question is, how does one apply this 20%? Does one apply it script-wise or does one apply it on an aggregate basis? I believe that the more appropriate thing would be to apply it on an aggregate basis, is the more appropriate thing to do rather than doing it script-wise. But again, I think this is something which, the question is really, so what is your source of income? Because see, I think one of the fundamental principles we very often forget a fundamental, but the fundamental principle is that you have to calculate income from a source of income first. All the sources under a particular head of income are aggregated, and then you calculate your gross total income. All the heads of income are aggregated to arrive at your gross total income. So when you're saying source of income, what is the source of income? And typically the way the courts have interpreted source of income is what a common man understands as a source of income. So is it each share or is it all your share portfolio together that you look at upon as a source of income? I think it's a slightly arguable thing. I would say that perhaps a portfolio would is what the department is likely to accept. But yes, it's arguable that each share, it could be a source of income. It's a separate source of income. But this is something which, the question then is, if you have not got a deduction under section 57, can you claim it as a part of your cost of acquisition of the shares? And there, as you know, that you had the old decision of Nayak where the Karnataka High Court took a view that so far as interest is concerned, interest on shares which is not claimed as a reduction under section 57 can be treated as a part of the cost of acquisition. Because it is an expenditure incurred for acquisition of shares and therefore it's a cost of acquisition. Similarly, you have the Madras High Court in 2008, Madras High Court in Trishul Investments upheld the view of the tribunal, taking the view that yes, interest can be claimed as a part of the cost of acquisition. There are tribunal decisions also, a number of tribunal decisions. I've just listed out 2 of them, Pune and the Delhi Tribunal. And the question then is that if interest is, a company is carrying on business, it also has investments. Can it claim it under 36(1)(3)? And there have been a number of decisions where they've said that yes, a company can. You have the Ahmedabad Tribunal in AdLife Investments. There is the Mumbai Tribunal decision, interestingly, where the company had borrowed money and invested in the shares of subsidiaries. This was an infrastructure company which had these toll projects under the, so each of those toll projects was an SPV. And they said that this is a manner of carrying on the business by the holding company. The holding company, the interest paid on acquisition of shares, which it has invested in shares of subsidiary, is clearly deductible because it is for the business which the holding company is carrying on through its SPVs. So that is the view which has been taken. And therefore, I think interest is something again, but as I said, again, something which is slightly debatable. There have been, as I said, in the context of land, we have Mithilesh Kumari, Andhra Pradesh High Court, you have a Delhi High Court. And in the context of shares, as I said, these two High Court decisions are also there. And I think there is a good case to say that yes, interest on shares should be deductible. But please remember, this is again something where there will definitely be litigation. The department still does not accept that. And particularly what happens is, we are talking about interest paid after the date that the shares were acquired. So you are looking at, say you have acquired the shares in 2021 and you are selling the shares in 2024. So right from 21 to 24, whatever the interest paid that is for that period, you are claiming as part of cost of acquisition. And therefore, again, so there this is, so I mean the normal this is that yes, for plant and machinery, whatever interest paid up to the date of installation of plant and machinery and put to use up to that date has to be capitalized, thereafter it is to be allowed as a deduction. That is the principle which we have in our minds, and that is where the difficulty arises. But I think on shares and land, etc., this High Court decision will really be the correct view of the matter. Looking at cost of acquisition, you have 655 2AC, which says your 31st January 2018 is the rate that you take, and when you acquired the shares before 31st January 2008. So when you take the higher of the cost of acquisition or the lower of the fair market value or consideration accruing. So effectively, you can never have a loss on account of taking 31st January 2018 rate because it's limited to the consideration. That's the thing. But if you have a gain, your gain can be reduced due to taking the 31st January 2018 rate. That is the position. Now, question is, there are various types of shares which are acquired after 31st January 2018, and I mean we are talking about listed shares here, so this applies only to listed shares. Obviously, it applies to listed equity shares, it applies to equity-oriented mutual funds, and it applies to units of REIT or InvIT, business trust as they call it. So that's it. So if you have got bonus issue, say after 31st January 2018, so today a company like a Bajaj Finance has announced a bonus issue. Now the bonus shares will not qualify for the 31st January 2018 date. So though you might have acquired Bajaj Finance shares way back in 2015, and you would have, if you had sold the Bajaj Finance shares before the bonus issue, you are able to claim the 31st January 2018 rate. If you sell it after that, you will claim the 31st January 2018 rate, but on 1/5 the value because you have a 5:1 bonus, etc. So that's the way it would work out. So you are really losing out to some extent of the 31st January 2018. Similarly, in the case of rights issue, what happens in a rights issue? Shares are allotted to you at a much lower price. The rights shares are, you have to take the cost of acquisition for whatever you actually pay for the rights. Because the rights are acquired after 31st January 2018. So again, to an extent, there is a diminution in value of original holding. So your capital gains gets lowered in that situation. In case of gift of inheritance, if say your parents, one of your parents passes away after 31st January 2018 and you inherit shares, there the question is, can you now claim it, the 31st January 2018 rate? Yes, I think you should be able to claim it because there you take the cost to the previous owner, the date of acquisition to the previous owner, and therefore automatically your 31st January 2018 rate should be eligible. So therefore should not be a problem. And again, we had this controversy again, as you know, in the context of indexation, what is the date from indexation, etc. But the whole scheme of capital gains is such that it relates back, and therefore you should be able to get the benefit of 31st January 2018 if your parent has acquired it prior to 31st January 2018. Convertible share debentures converted into equity shares post 31st January 2018. Again, the question there is, because as you know, conversion of debentures into equity shares is not a transfer. You have section 49(2)(a) which says that the cost of those debentures will be regarded as the cost of those equity shares. The question is, can you claim this as a deduction? And that's the real issue which we need to. What will you claim on 31st January 2018? Those equity shares which were allotted to you were not in existence. There will be other listed equity shares. Can you take that as this cost if you had acquired the convertible debentures prior to that date? I think this is, perhaps again the same thing as on inheritance. If you look at it, that you had acquired it prior to 31st January 2018 with a view to, and the conversion is not regarded as a transfer, it's exempt transfer. So the cost and the date of acquisition relates back. Can one take that view? I think there may be a little bit of difficulty over there because of there has been some sort of a debate on is it so far as the date of acquisition is concerned, and there have been decisions where they've taken a view that the date of acquisition is the date of allotment of the equity shares. There may be a bit of a difficulty, but to my mind, I think there is a good case to argue that yes, 31st January 2018 rate can be taken of the equity shares as of that date.
Sir, if the shares were acquired before 2001, and now you can take the value as of 2001. But suppose in between demerger is there in that company.
And that's the next point. So take a situation where listed shares, so for instance you are holding shares of let's say Aditya Birla Fashion and Retail. Now Aditya Birla Fashion and Retail, there's a demerger and you have Aditya Birla Brands shares you got. Now you are selling those shares of Aditya Birla Brands. What happens? You had one share that is now split up into shares of two companies post 2018. So can you take the 31st January 2018 and what proportion will you attribute to it? Can you say that, okay, the cost of acquisition is to be apportioned in a particular ratio of what is the net assets spun off in the demerger to the net assets that were there. So can one take that this thing? To my mind, legally, yes, there is a defensible case to say that yes, that's the way that the capital gain is to work. But practically, let me ask you that when you're filling up the income tax return, as you know, you're supposed to fill up the ISIN. Now, what are the shares that you're selling? You're selling Aditya Birla Brands shares. What is the ISIN as of 31st? That ISIN is coming into existence today. It was not in existence as of 31st January 2018. There was no rate as of 31st January 2018. And that's where I think practically one may have to, this is something where there will definitely be litigation. It's unfortunate that, this has not been amended, the law has not been amended to provide that in case of mergers or demergers, where say today, you may have had a share of a company which has merged into another company. You may not have held shares of that other company as of 31st January 2018, but you held shares of company B which has merged into company A as of, So company B shares were held on 31st January 2018 and company B was a listed company on 31st January 2018. So legally, I think there's a good case to say that yes, this is an exempt transfer. It is something which the cost goes back to the earlier cost, and therefore I should definitely get this as a reduction. I think that's something which one can argue, but practically, how does one fill in the utility? How does one claim? And particularly when the stakes are large, maybe it may be worthwhile taking that. Otherwise, practically also one has to figure out a way how to fill up the utility in a manner in which one is able to claim the benefit. Because to my mind, clearly it should be eligible. The law, unfortunately, does not expressly spell it out. That's the only difficulty that one.
So, for the company, we are comparing the value, which is lower than, now the value is lower and earlier it was higher, because earlier there was no demerger.
See, 31st January 2018 is a choice that you have. So, really, if you look at it, if your cost was higher, let me give you an example. If your cost was say 100 rupees and 31st January 2018 it was 80 rupees, you are selling it today at 150 rupees. Just a simple without a merger or a demerger. So what will you take as your 150 minus 100 or 150 minus 80? You will obviously take 150 minus 100. Because that's a choice that you have, that the cost will have to be taken as a, so that's the way I would look at it. So similarly in this situation, in a merger, demerger situation, you need to figure out, and as I said, you need to work out. So it has to be on a rational basis, so that is I think what is the important part of it.
What will be the date of acquisition of the demerged?
It relates back to the date of acquisition of the original share, and that's the thing, and that's why I'm saying that's the legal basis. So this, this was one thing which I just, like where shares were acquired in a pre-IPO. It was unlisted shares at that point of time. There was an IPO post 1st April 2018, and in the offer for sale shares, and there have been a large number of high net worth individuals who have been investing in these pre-IPO placements, etc., and selling is part of the offer for sale, particularly when the stake is very large. So there, as part of the offer for sale, and one of the things you need to remember is that in an offer for sale there is a STT paid. So therefore, clearly, the concessional rate of taxation under 112A is eligible. And there, the argument which was being taken earlier was that 55(2)AC does not provide for such sort of situation, and therefore the competition provisions fail. Therefore, capital gains cannot be taxed at all. That was the argument which was being taken. But there has been an amendment which has been made, retrospectively by the Finance Act 2024, with effect from 1st April 2018, saying that so far as shares which are part of which have been made as a part of the offer for sale, this part about the fact that competition cannot be made, there is an Allahabad High Court decision subsequent to the amendment, of course, but which has said that this amendment of section 55(2)HC on 1st April 2004 itself demonstrates that because of absence of any mechanism for calculation of fair market value in respect of sale of shares of an unlisted company, capital gains tax could not be calculated on sale or transfer of shares by the promoter shareholder under the offer for sale. So that is what the view which was taken by the Allahabad High Court. But by that time the amendment had come because they realized that a large number of, and as you know that summons have been issued to a large number of people who sold shares in an offer for sale, asking have you offered it to tax, what is the tax that you paid, etc. So those have been the thing. So this has been now plugged by saying that in the case, there also you will get your indexation up to 31st January 2018, and the index cost is something which you will be allowed as a reduction, is the way that they have. So only up to 31st January 2018 you will get your index cost, and the difference between that index cost and your sale price in the offer for sale, whatever is the price that you realize. Now, as I said, though technically these are not listed shares because the listing happens after the offer for sale gets concluded, but still you will get the benefit of 112 in this situation. So look at a situation where there were unlisted. There are. If you look at this thing 55(2)AC, there is a specific provision for indexation up to 31st January 2018, where shares were held and where the shares are listed on the deed of transfer, it became the properties were exempt transfer under 47. In that situation, it covers, it applies, and therefore, so for instance, if you had unlisted CCPS pre-IPO, you had acquired those unlisted, before the IPO, but post January 2018. Say take a situation where you have acquired those post January 2018 CCPS, etc. So there it should not be a problem, as I said. Then CCDs which are converted, so where the conversion happens, post 2018, January 2018. So there, because CCPS, you will see that there is specific provision under 55(2)AC which provides for that situation, because shares is preference shares will be converted to equity shares post January 2018 and then sold in an offer for sale. That will again be eligible. Similarly, the problem really arises in case of CCDs, as I said, if there is a subsequent IPO and you offer them for sale, there is a problem because of the. But there actually the cost of the CCDs will certainly be allowed to you as a deduction, is the way I would look at it. There is again, now this is again getting a little bit more popular, that people are lending their share securities. There is a stock lending and borrowing mechanism under which on the NSE and BSE you can trade. So suppose you're holding shares of Tata Steel and you find that I can lend it for 1 month and I will earn say 20 rupees, not 20, maybe 10 rupees is what I will earn on that. And I will, so those securities go out of my Demat account and after 1 month they come back into my Demat account. So, and I will get, for that period I will get 10 rupees, less brokerage of course is what, because it has to be. So the question here really is, how do you calculate your capital gains in a situation where you have lent shares, say you are holding a situation where you acquired these shares, say in June 2018 you had 100 shares. You acquired 120 shares in April 20 and another 150 shares you acquired in December 21. Cost is 100, 125, 150. You acquired 5 lakh shares in June 18, April 20 you acquired 3 lakh shares and December 21 you acquired 2 lakh shares. In July 22 you lent 5 lakh shares, 6 lakh shares. So therefore, on a FIFO basis, as you know, FIFO basis you calculate. So you assume that whatever shares you had acquired first, those have been lent out. So therefore, you had 2 lakh shares of which were acquired in April 20 and 2 lakh shares which were acquired in December 21. Now, in August 22, you sold 2 lakh 50,000 shares. How do you, before those original 6 lakh shares came back, then how do you, so what is left in your demat account is obviously that you sold, and therefore the shares acquired in April 20 and December 21, 50,000 out of that is what you will be regarded as having sold, is the way that you look at it, because that is the only logical way, because you can't sell what you don't have in your account at that point of time, because those lent shares have not come back into your account. But in a situation where the shares which you have lent come back into your account, there the question is that obviously when you sell the shares, you will look at when those shares had originally entered my account. I will not look at when those shares which were lent have come back. I will look at the original date of acquisition, and that's the way that I would look at it. And normally in most cases this will happen. It's a very rare situation where you have that the shares have been lent and then in that time only you sell some other share. But the lending fees which are earned by the lender, that these are taxable as income from other sources, it's not interest. So there will be no TDS, etc., but it will be other income is the way I would look at it. This is because this is a lending fee that you are receiving, it's not an interest. And what you are lending is security, and it's not lending of money. So now the very interesting question is that what about the dividend in that interim period? What happens is, suppose Tata Steel pays dividend, the record is in between the period that you have lent the shares. The borrower will get the dividend income, but the lending fees will be increased to the extent of the dividend income, and that will be paid to you. Now the question is that dividend or is that a lending fee? And I would say that the person who receives, the registered shareholder who receives this on that date, that is the person who dividend income it is. So this according to me would be regarded as a lending fee and not dividend income.
So what about pledge shares?
Yeah, so what is the issue on pledge shares?
The demat account said 12 out first, and then some shares are sold.
So if the shares are pledged, they still belong to you, the dividend comes to you, there is no problem over there.
The cost.
So cost apportionment, okay. So perhaps there also the question is on a FIFO basis, the pledged shares are kept aside separately. Thereafter you have acquired some shares, it's only those shares which you can sell. That's the only logical, because the original shares are still pledged. It's not that these shares go. So that's the way you have to, I mean, look at it from a logical thing, that if any board of the matter were to go and appeal, what would happen? You look at a common basis. I have pledged this. Now this obviously I cannot touch. It's only the rest that I can. That's the way I would look at it.
Sir, you said TDS will not be applicable. It cannot be treated under the contract.
Sorry?
TDS on, you said on the lending fee will
Yeah.
not be applicable.
So is it work? Is it contract of work? So if you look at the definition of work, etc., would it fall under that? So today, possibly it may fall under 194I, because for movable property and immovable property both it covers. So if it exceeds the limits under 194I, perhaps the question is again, this is through the stock exchange mechanism. Now, the way the stock exchange mechanism works, I don't think there is a provision for TDS today, because there will be multiple borrowers. So no single borrower. So it's not the stock exchange which is paying you or the stock broker who is paying you. It is multiple borrowers who are paying you. So I don't think you will ever have a situation, I mean, if you've not ever come across a situation where a single borrower has paid to one, and again through the stock exchange mechanism, it's, transaction wise it gets thing. So one is not in a position to know who the borrower is in that situation. That's the. So practically, I mean, I've never seen a TDS on lending fees. That's the.
So implications of capital gains on stock lending.
So where there is no capital gains at all, there very clearly, I think there is an exemption under section 4750. Any transfer in a scheme for lending of security under any agreement, the SSC entered into the borrower such security, and it is subject to guidelines issued by SEBI. So there is a clear exemption under 4750. So coming to bonus preference shares, I remember I had bought these Z preference shares somebody told me, wow, there's a superb rate of return you're getting on the Z preference shares. The rate of return is 16%. So I bought it. I said, wow, 16% is a superb yield under any circumstances, in today's time. So, I mean, it's almost an assured 16% that you get on redemption, effectively, because they're buying it at discount and on redemption you will get an X amount. Then I realized that these shares were bonus preference shares issued by Z. Similarly, you had Britannia Industries issuing bonus preference shares. Now, the position on bonus preference shares is, it is not dividend at the time that the bonus preference shares are allotted to you. Under the definition of dividend, you see, this does not fall under the definition of dividend at all. Because there is no release of company's assets to shareholders, there is no distribution of accumulated profits. So, what is covered is only issue of bonus debentures to shareholders or issue of equity shares to preference shareholders. Now, equity shareholders have got preference shares here, bonus preference shares, and therefore that is not taxable at that time. But there have been, when those are redeemed, at that time there is a release of the company's assets to the shareholders. The question is, if you are not an equity shareholder at that point of time when they were allotted, you bought it at later on, can it be taxed in your hands? And there we had the Gujarat High Court decision case of Shashikara Navneetan of 1964 decision, very long back. And again, it was an identical situation where the shares were purchased by another person, and on redemption they claimed that no, this is not taxable. And there the Gujarat High Court said that it's clear that when preference capital is constituted by application of capitalized accumulated profits, in paying up in full preference shares issued to shareholders as bonus shares, return on the preference share capital involved in redemption of preference shares must amount to distribution of capitalized accumulated profits representing preference share capital. And there they said that this is clearly taxable as dividends is the way. So I realized that this Z preference shares is taxable clearly as dividend. I quickly sold them off again in the market. Fortunately, markets I think had not realized that this is because these were bonus preference shares. So my entire redemption would have been taxed at 30% without allowing any deduction for the cost of acquisition. Otherwise, that was the position. So sometimes when you are buying preference shares and you are told it's a very good return and very good, try and understand whether it constitutes bonus preference shares, because that is the risk which one has. And again, the view which was taken in, by the Gujarat High Court has been followed by the AAR in 2005 in Briggs of Burton, again where they clarified that yes, it is taxable at the time of redemption of the preference share. Of course, the question is whether the Bombay High Court in Surat Cotton Spinning Mill, they said that can you claim capital loss of that cost of acquisition? They said that yes, you could claim it. That short-term capital loss is to be worked out by considering the redemption proceeds which are taxed as dividend. You take that as nil, and on the basis of nil minus your cost, you can claim it as a capital loss. So at least that is the saving grace which is there so far as the preference shares, these bonus preference shares are concerned. But this is something which you need to keep in mind.
At the time of issue, the company is liable to deduct TDS under 222.
Yes, they will be liable to deduct.
So that it is a dividend.
Correct. That also is something which the company is to be aware of. That yes, on bonus shares when they are redeeming the bonus preference shares, they have to be deducted. Bonus stripping, as you know, you had a Supreme Court decision which said that bonus stripping is something which is legally permissible in equity shares, bonus stripping equity shares. Then you had an amendment which said that, of course, bonus stripping of mutual funds was something which they had said that no, you will not get that as a deduction, should be added to the cost of acquisition. So now equity shares is also covered. It applies to units as well as securities. And as you know, securities include stocks and shares, units of mutual funds, AIF, REITs, InvITs, all that is the same. So where the loss is to be disallowed and added to the cost of those additional security, that is the bonus share in this situation. And of course, this applies where you acquired within 3 months prior to record date, and then you've been allotted these bonus shares, and then you have transferred those bonus shares within 9 months from the record date. Now, what if you transferred it 9 months and 1 day after the record date? Can you say that no, this does not apply to me and therefore it should not? Arguable, but what you need to remember is where the tax impact exceeds 3 crore, particularly where people are doing it in a large scale, where it exceeds 3 crore, then in that situation, GAR may apply. And the view of the CBDT is that though there is a specific anti-avoidance rule, the general anti-avoidance rule could also apply, the GAR could also apply in that situation. So it's something which, so planning it just that, okay, you're outside the 3-month period or outside the 9-month period is something which you have to be careful. Now particularly, and there is this decision which is today before the Supreme Court where the Telangana and Andhra Pradesh High Court, this is the only decision so far reported under GAR, where this was a classic case where there was a private limited company and there was this, the shareholder had made a huge gain. So what they did is, the private limited company's shares had been acquired at say 100 rupees. What they did is, therefore, that private limited made a bonus issue of a very large quantum. Immediately after that, the original shares were sold because price of the shares, say for instance, if it was 100 rupee paid up share, they give 1 rupee paid up, we made it 1 rupee paid up. So the cost went down, so the market value of the shares went down from 100, say it was 150, it became 1.5 because of the share from 100 rupees it became 1 rupee share. And they were sold therefore at 1.5 and the cost was say 10 rupee or 10 rupees or 15 rupees of the shares, and therefore, or whatever the cost 100 rupees they have been paid. So they claimed that as a capital loss and set it off against that gain. And this was all within sister companies. So this was all within the group. Then the Andhra Pradesh High Court looked at it and they said, what is this transaction? We have a private limited company which has never made a bonus. Shares are held by a group company. The shares are sold to a group company. Money also, what happened is the money flow also they tracked it and this is the money flow also went within the group companies. So effectively what you have done is the whole thing is commercially that nothing is achieved. It is merely to achieve a business loss. I mean to have a capital loss which can be set off against the capital gain which is otherwise earned. And therefore really this is clearly something which was done with the purpose of avoiding tax. And therefore they have held the invocation of GAR in that case. The matter is pending before Supreme Court. One will have to wait and see how the Supreme Court interprets it. But yes, this is the first case involving GAR and it involves securities. So therefore this is something which you need to be conscious of where the stakes are very large. Of course, GAR, as you know, applies only where the amount of tax involved is exceeding 3 crore in a particular year. So that's the thing. Coming to derivatives. Yeah, so buyback of shares, I did not want to cover it because I think now it's, today buybacks, very few companies are doing buybacks because of the fact that the whole thing is taxed as dividend now. You will claim a capital loss, because your cost of acquisition will be taken as nil and you will claim a capital loss of your cost of acquisition. But this is the entire proceeds which you receive on buyback will be taxed as dividend today. So therefore, really a buyback today, people used to do buybacks regularly earlier to be able to get the benefit of a lower, pay a buyback tax of 20%. That 20% effectively works out to some 18% with surcharge and cess also. It works out hardly 18% because of the fact that this is paid on the price that it is bought back at, the difference between the price and the issue price. But that, I think that planning is now, nobody is doing a buyback. Even listed companies are not doing it. Supplies to listed as well as unlisted company. So therefore it doesn't make sense doing a buyback at all, is the way that today. So practically I thought that there will not be situations where people would have done buybacks in the last 1 year and therefore I did not cover that. But clearly the entire buyback proceeds will be taxed as dividend to the extent that a company possesses accumulated profits. That's the position.
So in the hands of the investor, the cost of the investment is a sunk cost.
No, it's not a sunk cost. You get it as capital loss.
Capital loss.
Yeah.
Allowable capital.
Allowable capital loss. See, there is amendment in section 45 also, if you look at it. Okay, coming to derivatives, and this is because you have physically settled derivatives nowadays. That if the transaction, if your transaction is not squared out by the end of the settlement, then you necessarily have to take or give delivery as the case may be. And so far as futures are concerned, so you could choose to square up on that and take a new position, but in that case, only then it's cash settled. But if you don't do that, and they will. So what I wanted to draw your attention is the question is that if you bought a futures and that you obviously futures were bought at X price and then it results in a delivery, what is the cost of the shares which you acquired? Obviously, it is the amount that you paid for the futures that is taken as cost, and there you have the Bombay High Court decision in the case of National Exchange Members of India versus SEBI. And they have said that where derivative contracts were settled by physical derivative shares, transaction would not be any different from a transaction in equity share, where the contract was settled by actual delivery or transfer of shares, and the rate of STT is applicable to such delivery-based equity transaction would also be applicable to derivative transaction. So that principle, I think, is what the Bombay High Court is saying, that really what you have done is you entered into a future which has ultimately resulted in delivery. That is one transaction, and therefore your cost of the shares would be that. On that you pay as if it's a delivery-based transaction. And that, I think, principle would apply even in the case of, so far as cost of acquisition. That's a similar in the case of sales.
The date of acquisition?
Sorry?
Date of acquisition?
So the date of acquisition in that case, that's an interesting question, because as you know, CBDT has clarified that in case of shares, it is the contract date which contract date would it be, futures contract date, or would be, and I think there's a case to be made out to say it would be the futures contract date. I'll tell you why. You look at the Bombay High Court case, is the case of Vembu Vaidyanathan. Now Vembu Vaidyanathan was a situation where this was property purchase which was under construction. The agreement was entered into, the agreement was registered, and then property possession was taken after 3 or 4 years, and the property was sold after this. The question was, from what date will you get indexation, what is your date of acquisition, for is it long term, short term? Bombay High Court said that the date you entered into the agreement is the date that you acquired the property, is the way that they looked at it. So Supreme Court has rejected the SLP in Vembu Vaidyanathan. I think that was the position. So Vembu Vaidyanathan is, at least in Bombay, that is the position in which it stands. And I think that to that the same principle should apply here. I have entered into a contract for a particular share. The intention was to take delivery. I have ultimately taken delivery. So therefore, that is by date of acquisition. I think that's the argument we want to make.
What will happen in the case of redevelopment of
Sorry?
redevelopment property?
I think redevelopment property you can have an entire session separately. That's a whole, you could have. I can take 2 or 3 hours on that, but I don't think we have time for that. Let's stick to our subject of. So this was just an analogy I gave of remote property, but let's not stray from the subject. So similarly, in case of options, if you have paid a premium for the options and you got the shares of delivery, so there in that situation, obviously again the option premium which you paid plus the amount that you paid for when the shares delivery came, so both that will be regarded as your cost of acquisition. So therefore that's the way. Similarly, in sale will now, of course, in sale of options, it's typically is business income so far as the option writer is concerned, etc. So I would not get into that, but because that's another complicated subject which one can go on and on as to how the business income is to be calculated, etc. So of course there are issues about delivery given out of shares taken under the lending and borrowing mechanism. What happens? How does one calculate capital gains? So you have a situation where your sale takes place first and your purchase takes place later. So those are situations also which come up where I think unfortunately the return may not allow you to calculate in that manner, but that's the way it is, that your purchase is at a later date, and so you will have to figure out how to put the date in your utility, because utility will not accept that, but that's the way it actually is in law. That's the position. Coming to listed debt instruments, that's another thing. And you have listed debentures and bonds, where the rate was 10% without indexation for all listed security. That has become now 12.5% from 23rd July 24. Zero coupon bonds, again, they were at 10%. You had those notified zero coupon bond. NABARD, for instance, had issued those notified zero coupon bonds, where you were eligible for 10% without indexation. Now that has also become 12.5%. Unlisted debentures and bonds, which were earlier 20% was the capital gains tax. Now what happens is, it will be, you need to keep in mind section 50AA of the Income Tax Act. 50AA, effectively will, it will be deemed to be short-term capital gains under 50AA, and so those are issues which we have to look at. Now, question is, what about sovereign gold bonds which are sold in the capital, in the secondary market? Sovereign gold bonds, as you know, that if they are redeemed, it is the capital gains is exempt from tax. And people have made good money in these sovereign gold bonds, Reserve Bank. And the question, of course, is what about if there's a premature redemption? A premature redemption is also a redemption. It's a redemption by the Reserve Bank of India, and therefore, there again by the government. It's acting through the Reserve Bank of India, and there also it will qualify for the exemption and should not be a problem. But what if you sell the sovereign gold bonds on the secondary market? And that is a transaction which does not qualify for the benefit of the exemption. That is a taxable capital gain, very clearly. And the question is, would this be taxable under Section 50AA, and would it amount to a market-linked debenture? And what is the definition? Because as you know, market-linked debentures, unlisted debentures, and bonds all fall under 50AA, as well as unlisted debt funds, which have more than 65% in debt instruments. So the definition of market-linked debenture is a security by whatever name called, which has as an underlying principal component in the form of a debt security, and where the returns are linked to market returns or other underlying securities or indices, and includes any security classified or regulated as a market-linked debenture by SEBI. Now, what is the underlying so far as a sovereign gold bond is concerned? It's gold. Is it a security? Is it an index? No, it's neither a security nor an index. And therefore, I would feel that sovereign gold bond which is sold in the market will not attract the provisions of Section 50AA, is the way I would look at it. And obviously, it's a listed instrument, it's not an unlisted instrument, and therefore that also principle will not, that provision also will not apply. 50AA will not apply in this situation. The other line which we are seeing this happening, and for instance, Indore Municipal Corporation had issued bonds. So the bonds had four components. One was the principal component, one was the interest, which is due on particular dates and component, etc. So what are those called? Those are called as separate trading of interest and principal. So that's called a strip. And we had the CBD Circular 2 of 2002, which had clarified how deep discount bonds are to be taxed. And there, the second part of the circular had also referred to how is taxation of strips to be done. So what is a strip? So you have an instrument and you have an interest component. What you do is, you say that this interest, whatever the interest component, I'm selling it as a separate, it can be traded separately. The principal component is traded separately. So you're breaking it up into two separate, one instrument which is consisting only of principal and interest thereon. You're breaking it up into two components is the way that it happens. And the CBDT has clarified that stripping of a normal interest-bearing bond into its various components will not amount to a transfer. So that is one aspect. So therefore, if you had instrument was issued, as one instrument, but then it's subsequently broken up into various components for purpose of trading, that will not amount to a transfer. Is the taxation is on the same lines as in respect of deep discount bonds. So say for instance, there was a cumulative bond which was issued. Say the bond was issued at 1,000 rupees, redeemable at 1,500 rupees. The interest thereon was at 500 rupees on redeemable after say 10 years. Now, how would this strip work? You would say that the principal will split it separate, 1,000 rupees principal. On redemption, you will get 1,000 rupees back. And the 500 rupees will be traded separately. So how does the market price this? They will say that you're getting 1,000 rupees after 10 years. So what is the current value? So they will discounting will be done to arrive at the discounted price today. Similarly, that 500 rupees after 10 years you're going to get 500 rupees. So what is the discounted value of that today? So what are you doing? That whatever was you are supposed to receive on redemption 1,500 rupees, you're breaking it up into two components. So therefore 2/3, 1/3 is what the market will attribute. Assuming that they were both due for redemption on the same day, the market will say, okay, so you're breaking it up into 2/3 is the principal component and 1/3 towards the. So therefore, the question is, that's the way that you will attribute the cost. Suppose if you sell only, now you bought, assuming you subscribe to this bond, you paid 1,000 rupees today. Suppose you sell off only the interest coupon, you sell it off. You will get, say maybe, you will get 200 rupees. What is the cost of that? So therefore, that's what you need to look at. 1/3 is what I would attribute, because out of the 1,500 which was to be redeemed after 10 years, you've sold off the 500 component and 1,000 component you've retained. So therefore, 1/3 of my cost is what I will attribute towards what I've sold. That's the way that I will look at it. So and if I sell off the principal bond, again, I will attribute the proportionate, that's the way that the proportionate cost is what I would approach it. Though there is no specific provision, for merger or demerger there is a specific provision. Here there is no specific provision, but this is, I think, what I should do, again, as I said, apply what is a commonplace, how would it, is it rational, is it, yes, that's the way. I got two things, a combined thing, I broke it up and I sold part of it. So it's like today I buy a house. I sell, again, please let's not go into the immoral property, don't ask questions on immoral property, but I buy a house, a 25% share I sell to somebody. 1/4 of my cost is what I attribute to it. Very simple. The same principle applies here, is the way I look at it. Of course, the CBDT talks about that you do a market valuation as on 31st March of each financial year and mark the market, etc. Difference is taxable as interest income. So, these are the things which, but these are the issues which come up so far as trading in, strips, as you call it, separate components of a bond, which, as I said, the classic case is this Indore Municipal Corporation bonds, which we have issued 4 different. Coming to mutual funds. Mutual funds, here you have, again, mutual funds has made it extremely confusing because of 50 AA and your equity-oriented mutual fund, etc. Just to try to simplify it and look at this. You had earlier short-term capital gains rate for equity-oriented mutual fund, you had 15%. From 23rd July 24, it became 20%. The 10.5%, which was the 10%, which was up to 22nd July, has now become 12.5% for equity-oriented mutual funds. 50 AA, the last, 50 AA is the third line which you look at. So those who invest 65% in debt and money market instruments, there it doesn't matter whether short term or long term, the whole thing is deemed as short term capital gains. And so 65% has to be invested in debt and money market instruments. There was some doubt as to, because the definition, the way it was defined earlier, it said that does not invest, more than 35% in equity. So therefore, gold bonds, etc., gold mutual funds, etc., all that was falling in. Now, fortunately, I think there is clarity, and it talks about investing in debt instruments and money market instruments. So therefore, it's only those debt funds which invest more than 65%. Now, there is a case of debt mutual funds, of course, which invest between 35 to 65%. What is the position there? There you will get 12.5%. The period now, of course, from 30 months has come down to 24 months. So therefore, that's one thing. And of course, you have the mutual funds which are acquired prior to 31st March 23 and which invested more than 65% in there. Still, you will get the 12.5% there because this applies only to acquisition from 1st April 23 onwards, mutual funds. So, if it's a non-resident, there is no difference really. The same rates apply for a NRI or for a resident.
It is 24 months, is reduction of 24 months. Even the debt instrument required, debt instrument required before.
So if it is, question is 65% or more, then it goes automatically under 50 AA. You don't then have to look at the holding period.
For long term or short term buyback?
That doesn't matter. If it is 50 AA, it is all deemed to be short term.
Right. But suppose
so if it is between 35 to 65, say you have the balance advantage funds.
right.
So it's between 35 and 65, so it may not qualify the equity oriented fund because not more than 65% equity. And so debt component between 35 and 65. Now there you will get the 12.5% and 24-month period only.
But even if acquired before 23rd July.
So yeah, even if it is acquired before, the date of acquisition does matter. There the date of transfer matters. Yeah, for NRIs, I just wanted to bring out it. This is something which very often we tend to miss out. There is for capital gains for NRIs. It would depend upon the country of residence. There is an article on capital gains in the double taxation avoidance agreement for most countries, and that capital gain says basically immovable property will be taxed in the country in which the immovable property is located as per the laws of that state. It says so far as equity shares are concerned, equity shares will be taxed as per the laws of the country in which the company is situated. Is most of course you have Mauritius and Singapore are exception, but where it were exceptions. But again, then you have saying that if it is assets of a permanent establishment, that will be taxed again in the country in which that permanent establishment is located. Then you have a residual clause. See, capital gains on transfer of other assets will be taxed in the country of which the alienator is a resident. So, alienation of assets, that is transfer of assets, other than equity shares or immovable property or assets of a permanent establishment will be taxed in the country of residence of the seller. Now, this typically is, now of course it's not every treaty which has that. Some treaties like the US treaty for instance says that it will be taxed, so where the property is located, etc. So, will be taxed, US treaty just says that it will be taxed according to the laws of the respective state. So there are no separate points over there. But most of the treaties have this separate clauses, and where so if the NRI is a resident of the US, he will be taxed in India. There is no doubt about it. He will be again taxed in the US, and he will get double tax credit. That's not a problem. But if you look at the treaty with Singapore, if you look at the treaty with UAE, so you have this residual clause which says it will be taxed in the country of which the seller is a resident. So which means that if there is capital gains on sale of mutual fund, whether long term or short term, it will not be taxed in India. So that is the position of the, and we have a number of tribunal decisions. Of course, Supreme Court has very clearly clarified units of mutual fund is different from shares, which is the obvious. I think I don't know why they matter to go up to the Supreme Court, but this is very clear so you have these tribunal decisions where all of them they've taken a view that it is not taxable in India on the gains on sale of mutual fund is not taxable in India. Just one point I wanted to draw your attention. There is under Singapore Treaty there is no specific thing, and there is a limitation of relief article also, Article 24(1). Because you have to read the treaty as a whole, you can't read only a clause in isolation. And it says, where this agreement provides that income from sources of the contracting state shall be exempt from tax or taxed as a reduced rate in the contracting state and under the laws in force in the other contracting state, the said income is subject to tax by reference to the amount thereof which is remitted to or received in the other contracting state and not by reference to the full amount thereof. Then the exemption or reduction of tax to be allowed into this agreement shall apply to so much of the income as is remitted to or received in the other contracting state. So, the question here is that in Singapore, capital gains are not taxable. So, is it taxable in Singapore or not, or what is the receipt, etc.? So, typically the department has tried to say that no, under this was intended to acquire cover a situation where it is not taxed at all in Singapore. So, no, it should not be that no country taxes it. Because what will happen is for a Singapore resident, the mutual fund units, capital gains will not be taxable in India. It will not be taxable in Singapore either, and therefore it's completely tax exempt. That's the thing. There is, of course, the Bombay Tribunal has looked at this, and there is the same decision where they said Article 24(1) applies only when income is either exempt or taxed at a reduced rate in one country, that is Singapore, and it's in one country, that is India, and it's taxed in the other state, Singapore, based on remittance, not accrual. Since Article 34 is a taxing provision granting exclusive taxation rights to Singapore, not an exemption, Article 24(1) will not be applicable in the view of the Bombay Tribunal has taken. But what I advise is when you're advising your clients, if you're a tax resident of Singapore, please advise them that remit the money to Singapore. So therefore there is no debate that their money has been remitted to Singapore, so that is the thing. So in that situation, you should be able to get the benefit of the exemption. The other thing also, of course, when we are talking of treaties, and very often one forgets that under certain treaties, there is a lower rate of tax. Now, as you know, for a non-resident, the rate of tax on dividend is 20%. But under tax treaties, you may have a rate of 15% in many tax treaties. So please look at the tax treaty also. And of course, one will then advise the client that get a tax residency certificate so that you get the benefit of the lower rate. But this is something which one very often tends to forget, that just because they are NRIs doesn't mean that they are not entitled to benefits of tax treaty. They can get the benefits of a double tax treaty. So this is something which we need to keep in mind.
So the share is purchased at the time when the person is resident. Now because of the UAE treaty what you referred, so we need to see at the time of sale or both the things?
At the time of transfer.
At the time of transfer.
The question is, let me ask you one thing. What is the dividends? What rate will you apply? Will you apply 20% or will you apply 30% rate?
Yeah.
When is the non-resident and he receives the dividends from those shares? At that point of time, no. Transfer is also taxable at that point of time. So you, at that point of time, what is the status is what you have to look at. So it doesn't matter if it was acquired out of rupees, it was non-repatriable, whatever.
Irrespective of the purchase of the share, the status of the SSC.
Absolutely. The residency status is what. And it may be on a non-repatriable basis. Now, Singapore residents, I would advise that you keep it on a repatriable basis so you can repatriate the money, or at least repatriate it under the $1 million scheme, even if it's non-repatriable, is the way I would look at it. That's the. Let's move on to InvITs, REITs and AIFs. Again, this is something which I think, very often many of us don't really look at or understand, and I think it's something which is very important. And let me give you an example. I mean, I invested in some REITs maybe around 3 or 4 years back. Those REITs today have doubled in value, is one thing. Second thing is the rate of return which I'm getting on those REITs today is almost a 10% net of tax. So just to give you an idea of how REITs can really this, if it's looked at in a smart manner. So this is something which maybe when you're advising your clients, etc. Now InvITs of course also give you a good return, but see the difference between a REIT and an InvIT. What is the same? So let's look at what is the structure of a REIT and an InvIT. It's just like a mutual fund. Instead of investing in shares, what they do is they invest in companies which carry out the activity of buying and renting out office property, or which is a REIT, or sometimes malls also. Say for instance, you have Nexus Select REIT which invests in malls and hotel and office properties, or you have say a Mindspace Business Parks REIT, which or a Embassy Park REIT, or there's one more REIT which Brookfield REIT. All these invest in office properties and they rent them out. They so that rent is something which those SPVs then declare dividend or interest income to the REIT, which is like a trust, similar like a mutual fund. So you have a trust structure. You have the InvIT of the REIT, which is a trust structure. There's a trustee company. There's a investment manager. And for managing those companies below, the properties below, you have project managers who handle each of those properties, etc. Take care of those properties. So what happens, the investor money goes into the trust, which is the InvIT of the REIT, and then that is invested in those SPVs. The investment in those SPVs could be through equity shares, it could be through NCDs, it could be through CCDs, it could be through loans. Now, whatever is the cash flows which come to the InvIT or REIT, which could be by way of dividends. So, what will happen is the SPV will, let's look at a REIT first. A SPV will earn rental income. That rental income it will declare by way of dividend. Firstly, it will either pay interest on those loans or NCDs. It will declare dividend. It may partly redeem those NCDs or loans, and so that is the cash flow which will flow into the REIT. Now that REIT in turn is supposed to distribute every quarter whatever are the cash flows that it gets. 90% of the cash flows have to be distributed to the investor, and they will give you the breakup, saying that out of this money which I have received, 50% is dividend, 30% is interest, 20% is a return of my capital, and maybe 5% is some other miscellaneous income, etc. So they will give you the breakup. And they will issue you the Form 64B at the end of the year. Every investor will issue a Form 64B at the end of the year, saying what is the component of, what is the amount of dividends given to him, what is the amount of interest given to him, what is the amount of repayment of the capital or the loan or etc. given to him, and other income. And about what is the TDS you had in there. So TDS, now the way it works, so far as the InvIT is concerned, what the InvIT does, it does not, the SPVs in which it invests, they invest in projects, say for instance a power grid project. So there's a concession, a power grid concession is given by the government for 30 years. Or they will invest in a toll road where a concession is given for 30 years. So they will, what is their inflow, they will collect toll revenues, or they will collect for lease of the power grid, for use of the power grid lines, they will collect fees from the electricity companies, and that is their income. Now against that, what happens is that unlike in a REIT, you have the depreciation in the value of the building, but the land remains the ownership of the REIT. In InvIT, what happens is there is also a diminution in the value of the concession agreement that you have. So if the toll project is for 30 years, then 1/3 and 1/30th, so 3% effectively every year is the diminution in that value. Every year they're supposed to revalue, they're supposed to announce their NAV, they're supposed to value the project, what is the value as of the end of the year, etc. and they give that. So effectively what happens is that, as I said, today there are, for instance, some of the REITs, if you examine it, one of the REITs, almost 95% comes by way of dividend. Now, this dividend is not taxable in your hands if those SPVs below those in that have not opted for 115BAA. So they have not opted for the 22% rate. They have continued to pay tax at the 25 or 30% rate, as the case may be, in that situation. So in that situation, what happens is the REIT does not pay tax. You also don't pay tax on that dividend. Interest income, the REIT does not pay tax. You pay tax on that. So if there is a capital gains, again that capital gains is passed through again. And so if you look at the components of it, as I said, interest income is exempt in the hands of the REIT, taxable in the hands of the unit holder as income from other sources. Dividends, whether SPV has opted for 115BAA, is exempt in the hands of the REIT, but taxable in the hands of the unit holder because the SPV has paid tax at a concessional rate, so the dividend not exempt in the hands of the unit holder. But if it has not opted for section 115BAA, REIT does not pay tax, investor does not pay tax, fully exempted or passed through basis. So far as the rent is concerned, it is exempt in the hands of the REIT, but taxable as income from other sources in the hands of the investor. Capital gains, is it taxable in the hands of the REIT? The REIT will pay tax on it, but the investor will not pay tax on it. That's the thing. And business income, again, the REIT will pay tax on it, and it will be exempt in the hands of the unit holder. So this is the way that this whole this operates. And therefore, as I said, this is something which very often, is a good instrument of investment so far as investors are concerned. And so far as repayment of debt by the SPV is concerned, how will what happens is the SPVs have depreciation. That depreciation, the cash flow is higher to the extent of the depreciation to that extent because, all other amounts, cash flows may be involved, but so far as depreciation is concerned. So depreciation also to the extent of the cash flow, to the extent of depreciation also goes up. Now the unit, obviously the REIT or InvIT has to distribute it to its unit holders, and therefore, that amount was earlier not taxable at all. There is, with effect from assessment year 24-25, it says that this amount is really, what is it? It's really repayment of the unit capital of the investor. So you reduce it from the cost of acquisition. When it exceeds that, the amount, not the cost of acquisition, but the issue price. When it exceeds the issue price by that REIT or InvIT, suppose now for instance Mindspace Business Park REITs are issued at 300 rupees, Nexus Select Trust are issued at 100 rupees. When this debt repayment exceeds that 300 or 100 rupees, then it becomes taxable as income from other sources. So that is the position. Now there could also be a situation where I have bought these REITs or InvIT from the market and I have sold it to the market. Now, of course, one is that this part about what I have to reduce from my cost, does it apply to the period prior to the date of my acquisition or the date prior to the amendment, prior to up to assessment year 23-24 also there were REITs and InvITs which have distributed. What about that? To my mind, I think it's only from assessment year 24-25 that you are required to reduce it. In earlier years, it was not required to be reduced. So far, of course, most of the REITs and InvITs have the repayment of the debt component which has come to the unit holders has been maybe around hardly 10% or 15% of whatever they have invested, and therefore that's really not significant. So there's nothing taxable, and I don't think there will be anything taxable for the next 8 or 10 years at least. But the question is that today when I'm selling, so whatever is the principal amount that I've got as repayment during assessment year 24-25, I will get the distribution every quarter. Also, they give you a chart. Also, the Form 64B, many of them do give you these details, and you will have to reduce it from the cost of acquisition. Is the way that you look at it. So, interestingly, for REITs or InvITs, the holding period is only 12 months for it to classify as a long-term capital asset. So today, it is of course earlier it was taxable at 10% long-term capital gains. Today, it is taxable at 12.5%. But keep this in mind that you have to reduce this debt component which you've got back, the repayment for assessment year 24-25 onwards. That is something which we need to keep in mind. So that was what I wanted to draw attention, and today I think it's an extremely good thing to give you a fixed rate of return, because every quarter there are distributions of the cash flows, and some of them have got extended repayment of cash flows. You get a good rate of return on this. Alternative investment funds, is another thing which we very often now today, because only high net worth individuals invest in alternative investment fund, because it requires a minimum investment of ₹1 crore. Unlike a REIT or an InvIT, which you can just buy from the market at ₹100 or ₹300 like any share, etc. Here this requires a minimum investment of ₹1 crore. This is not a listed thing, it is something which, so again this is a pass through. Basically you have two types of AIFs. You have category 1 and category 2 AIFs. Again, these AIFs collect your money and they will invest it in various instruments depending on what that AIF is for. So many AIFs are for equity AIFs, where they invest in equity shares of unlisted companies, etc. So that is the you could have AIFs which actually carry out trading strategies in the market, and the category 3 AIFs, which are like hedge funds or etc. Those are the things. But typically, a venture capital fund, a private equity fund would be structured as category 1 or a category 2 AIF. So category 1 AIF, there are 4 or 5 classes in that, and so similarly they're structured as trusts, sometimes as LLP they're structured. You have a manager and who manages the investment manager pays some fees, etc. And so they invest in equity share, preference shares, CCD, debt instruments, derivatives in various companies. So these are not SPVs. So they are like so for instance, some AIFs suffer huge losses because they're invested in Byju's, which is an unlisted company again. So therefore that's all. Now category 1 and category 2 AIFs are passed through. So all incomes except business income received by the AIF is liable to tax in the hands of the investors. Now here the AIF will issue a form 64C at the end of the year, giving what is the breakup, which is taxable in the hands of each investor. So each investor will get this. Business income is taxable in the hands of the AIF, it is exempt in the hands of the investor. There is so AIF itself, when it earns any income from the investee company, there is no TDS. There is CVT circular which has clarified that there is no TDS required to be deducted at source on income which is paid to an AIF. So far as when the AIF distributes, again this is required to distribute 90% of whatever it receives. It is required of the cash flows. It's required to distribute to the investors. When the AIF distributes it to investors, it will deduct TDS under section 194 LPP. And the nominal rate of deduction for a resident investor is at 10%. For a non-resident investor, it is at the rates in force. So therefore, it will depend on the Finance Act, rate with the treaty, etc. It will determine what is the rate which will be applicable so far as this. Now, interestingly, category 1 or category 2 AIF does not normally carry on trading activity, and therefore there is if you look at the definition of capital asset, just like for an FII, they said that all securities held by an FII will be treated as capital assets. So for category 1 and category 2 AIFs, all securities held by category 1 or category 2 AIF will be classified as capital assets and not business stock in trade. So that is now the question is, for losses, yes, as I said that there is a specific provision for carry forward of carry through of losses to the investors. But what happens to expenses? Just like a portfolio management fees, today the manager is paid certain fees. There is an audit fee of the AIF which is done. There is a valuation which is required to be done at 6 monthly intervals for the AIF. So there are various costs which are incurred at the AIF level. Now those also, obviously the AIF is not distributing them to you, it is paying it on your behalf really, if you look at it, because it's supposed to be passed. The question is what is this thing? And so you have investment manager fee, trustee fee, audit and valuation fees, transaction legal costs, etc. And we should constitute up to 30% of the AIF's corpus is what is permitted. Though of course in most cases not so large, but it could go up to 5% of the income typically. And there are these tribunal decisions which have held that yes, these are also passed through. So what is taxable? If the AIF could have claimed it as a deduction, then the investor can also claim it as a deduction, is the way that it is. But what you need to remember is This was prior to the amendment to Section 57. Now this income, typically if the AIF has earned dividend income, if it has earned interest income. Now dividend income, as you know, is subject to no deduction except interest. Now AIF typically does not borrow in this situation a category 1 and category 2 AIFs. They just take investors' money and that is deployed. So there, the problem is if dividend income, it may not be deductible, but possibly capital gains or interest income, one will maybe have to try and see or get claim over there. So that is, I think, something which we need to keep in mind.
So this is the management fee, right?
Yeah, management fee. So there will be management fee. There will be other expenses also because under 57, again, dividend income is not allowed any expenditure. That's the problem. So there will be audit fee, there will be valuation fees, there will be other things. Now, yeah, of course, transaction and legal fees are typically paid for transactions where there's capital gain. So those can be claimed as expenses correction transfer.
But I think they are not disclosing to the unit holder.
So some AIFs are mentioning that these are the expenses that we have incurred and this is there. So that's where again, so therefore it depends on the transparency which that AIF has. ICAI, for instance, ICAI Ventures, for instance, issues that I know for a fact. So that's it. Now there is this other category of AIF, it's category 3. Now category 3 AIF is typically an AIF which carries on trading activities, etc., which borrows money to carry on hedging, it could carry on trading derivatives, etc. Now that is taxable at the AIF level. Now there, whatever is earned by the AIF pays taxes and then distributes it to the investors. So in the hands of the investors, it is exempt from tax. That is the thing. And there, obviously, whatever the income that they earn, there will be TDS deducted. Suppose they put it into bank fixed deposits, bank will deduct TDS on that. But the important thing you need to remember is that AIF is carrying on business. It is taxable at the maximum marginal rate. Normal trust taxation under Section 164, so therefore would apply. 161 to 164. So those would be the. When they distribute income to investors, obviously it's exempt in the investor's hand, so therefore there is no TDS requirement over there. It's only for distribution by category 1 and category 2 AIF that the distribution is there. Now, there also what has happened is we've noticed that there have been cases where people have bought AIFs in a secondary transaction. So this is not traded in the stock markets. But today, if I want to buy units of an AIF, and at that point of time, that AIF has finished its commitment period, so therefore people who have already invested. So there is some investor who wants to exit, and that comes to me as a proposal that would you be interested in buying those units, and I buy that, and there I buy it at a premium. Now, as I said, that normally what happens is the AIF, whatever income is earned in that AIF is distributed. So if I buy it at a premium, now what happens to that premium which I paid? Or if I buy it at a discount, what happens to the it goes on repayment over a period of time, what happens to that differential? According to me, that differential also gives rise to a capital gain or a capital loss, and that is something which one will have to work out every year, because this is independent of the pass-through income. So income of the AIF is one thing, and income because of the AIF instrument, because what you have to remember is units of an AIF are also securities as defined under the SCRA. Similarly, income of a REIT InvIT also defined as, like units of mutual fund. So they are also securities. So it is you're making a gain or loss on redemption of a security in a sense. So therefore that is separate from the income earned by that, on a pass-through basis by that AIF itself. So that's the way I would look at it. And lastly, the topic I'd like to cover is overseas investment, because you see that we're seeing a large number of investors today investing in overseas countries. Of course, one word of caution which I would just like to sound, and which you should maybe advise a client when they're there. See, in the US, a lot of people invest in US stocks. It's very attractive because you have Nvidia going up by 500-600% in a year, and so 5 times, 6 times appreciation in a year, and it looks very attractive. Amazon doing very well. It looks extremely attractive. There is an inheritance tax in the US. The inheritance tax, you say, oh, it applies at $12 million. I'm not investing $12 million. I can give only $250,000 a year under my IRS. So I'm investing $100,000, whatever small amounts. But that $12 million inheritance tax, $12 or $13 million inheritance tax limit applies to a person who's a citizen of the US or a resident of the US. It does not apply to a non-resident. In the case of a non-resident, the limit is $60,000. So if, suppose a senior citizen is investing at $100,000, something happens to him, monies are inherited by his wife, there will be an inheritance tax of 20% to 40% in the US. And that is not on the appreciation, it is on the investment amount. So this is something which people are not very much aware of, and therefore, now to that, they'll say that I want to invest abroad, what do I do? So just one is, of course, you invest in the ETFs of Indian mutual funds which invest overseas. And just yesterday, for instance, there was an announcement, I think DSP Mutual Fund has announced a global equity fund from GIFT City. Now under LRS, you can remit money to GIFT City, you can invest in that mutual fund will invest in equities worldwide. And that is now what you are holding is units of a mutual fund, of a fund. That retail fund is investing worldwide. So if something happens to you, retail fund is not liable to inheritance tax in the US. So therefore there is no risk over there. That's the way I look at it. And therefore this is something which is something which you need to keep in mind when you are advising on overseas investments. When you see a client has got overseas investments, particularly in US stocks, etc. So in fact, I've had a situation where a client who is a senior citizen has just gifted shares worth crores of rupees to his daughter, saying that I don't want to take the risk of this inheritance tax in the US. And interestingly, there is, you have to look at gift tax in India. In India, obviously, gift to a daughter is exempt. But in the US also, the shares which are held are not regarded as property located in the US. That's a very interesting thing which I found. And therefore, it is not liable to any tax so far as the US is concerned also, non-resident to non-resident transaction. So now the question is, what about taxability of dividend received on foreign shares? Does this surcharge cap of 15%, which is there for dividends, as you know, dividends and capital gains, which are subject to the special rates, are subject to a cap of 15%. So the question here is that what about dividend received from foreign shares? Yes, that is also eligible for the 15% cap on the surcharge. So you don't pay tax at 39% on that, you will pay tax at whatever, 35 point something percentage on that effectively, because the 15% is the cap. Again, deduction under section 57, the same principle applied as dividend income, so therefore it will not be allowed, So dividend doesn't depend on whether it's an Indian company or foreign company, it will not be allowed to US deduction. If there is on US, they deduct, for instance, withholding tax is there is a withholding tax of 25%, I think, against on dividends. So there you will get a credit in India, but you have to file the Form 67, you will have to get the proof of the withholding, you will have to attach along with the Form 67. The Form 67 earlier you had to file it before the due date of filing the return, now it is extended to 31st March. So for this year's returns, you will have to file it by 31st March 2026. But remember, if you forget to file it, then there will be a demand and then you may have to fight it out, is the thing that you need to keep in mind. For the period of holding for foreign equity shares, it's 2 years, because it is not listed shares. So though it may be listed on the New York Stock Exchange or on NASDAQ, it is not a recognized stock exchange. Recognized stock exchanges are only stock exchanges that are recognized by SEBI under SCRA. So this is not a recognized stock exchange, therefore 2 years period will apply, not 1 year period. The rate of taxation, there will be no STT, therefore section 112 will apply. Of course, it doesn't make a difference today. Only you will not get that 1,25,000 which you get under 112A, that's the only difference, but otherwise it's at 12.5%. Now, what is the rate of conversion for calculation of capital gains? Suppose I have invested, say 1 lakh rupees. At that point of time, the dollar rate was say 50 was the dollar rate for so it was $2,000 was what I invested. Now I sold it for say $2,500, and the dollar rate for simplicity's sake is 100. So I've sold it for 25. So the question is, what is it that is taxable? Is it in rupee terms that I calculate the gain and pay tax, or is it in dollar terms? There is a tribal decision in the case of ICICI Bank, where they said that ICICI Bank claimed indexation as well as calculated in foreign exchange term. They said no, you have calculated foreign exchange term is what ICICI Bank claimed. So tribal said no, you can't get double deduction, you will only get indexation. This is what they said ICICI. But I'd just like to draw your attention that there is a rule 115. Rule 115 applies to all types of income, and they said that what is the exchange rate that you apply. For capital gains, they said that it is the month preceding the date of transfer. Whatever is at the end of the month preceding the date of transfer, that is the exchange rate that you have to apply. And there, what they have, there is Karnataka High Court decision in the case of Jaya Kumari and Nilhar Kumari, where they said that Rule 115 applies. And there, if you look at it, they've given the example of how it applies, etc. Then it was actually a situation where it was invested in UK pounds and then redeemed and then brought back to India. So what will be happens is that it is, there's also Rule 115(2), if you say, it says if the money is brought back, into India, then whatever the actual rate is what it says. But that does not apply to capital gains. If you see, it applies only to 115(3). It does not apply to the other components. And it applies to income from other sources, it applies to business income, but does not apply to capital gains. So therefore, I would feel that you will have to calculate your capital gains in terms of that foreign currency and then convert that capital gains into Indian rupees. That's the way that your capital gains computation will have to apply. Foreign ETFs, they may be shares, debt instruments. It's again, it's not a mutual fund as because it's not recognized by SEBI, etc. So the surcharge cap will not apply because that applies only to dividend, does not apply to mutual fund distribution. Period of holding, it's because it's not registered with SEBI, it's not a mutual fund under 1023D, and therefore the holding period is 24 months. 50AA would apply to GSEC or debt fund, debt ETFs. And the unit of specified mutual fund is that we invest more than 65% of debt and money market instruments. And the definition is debt and money market instrument includes security by whatever name called, classified or regulated as debt and money market instrument by SEBI. So now, so practically, if you see, it says classified or regulated. Now SEBI may say that okay, these treasury bills are this, but the question here is there could be certain debt instruments which are not classified by SEBI. Similarly, how does one determine the 65%? Because one has no access to those details, and therefore, to my mind, I think 50AA should not apply is a better view, but it's something which is subject to. Now, for capital gains, as I said, Rule 115 will apply over there. The same principles as for shares will apply. Withholding taxes also the same principles will apply as we had for so far as shares is concerned.
Sir, I have a question regarding capital gain. As you said, $2,000 was. Suppose I have sold for $2,000 only.
No capital gain arises. Zero. Absolutely. Zero.
What about that exchange gain?
Sorry?
Exchange gain.
So exchange gain is not taxable over there, is the my view. Because you have a specific provision, Rule 115, which applies there. That's the.
But it is not specifically covered, like in first provision, what is.
See, there is a Bombay tribunal decision where the loan was given in foreign exchange and received back. And there was exchange gain, and tribunal said it is not taxable. Same principle.
Like in FDI, we have specific provision for this first provision, NRI making the investment through foreign exchange.
Yeah, the chapter which is there for NRI. So there again, foreign exchange asset which is rolled over, etc. That's for inward investment. But for outward investment today, there is nothing.
But for inward, if the NRI is making investment from NRB account or FCNR account, whether that will be counted in that first provision or not counted. Suppose foreign exchange, if it brings foreign exchange, then it is counted.
Correct.
But if it is
NRE also I think is covered. If you look at the chapter, I think that's clarified what is foreign exchange. So NRE would clarify, NRO would not. So just a couple of the things. I think we are running out of time, and just got 2 or 3 slides, a couple of slides on the foreign crypto ETFs. So there are crypto ETFs which are approved abroad. So investment in cryptos, as you know, is a problem because of the rate of tax. It's this thing, etc. Government is frowning upon it. But crypto ETFs, what are this? So this is not a virtual digital asset as defined, because it's an ETF really, and that ETF is investing in cryptos is this thing. So 115 BB8 will not apply. Here I think it will be the 2-year period at the 12.5% under 112 which would apply. Government securities and treasury bills, again, treasury bills are, so again, whether this would be treated as an unlisted debenture or bond under section 50AA, perhaps, that it may get hit by that. And the Civility Circular 2 of 2002, because US treasury bills typically are allotted at a discount and then redeemed at par. So therefore, that deep discount bond circular is something which you need to keep in mind. 57, you get deduction against interest income. There is no problem in claiming deduction. That's not a problem. Again, so if 50AA does not apply, one can, if it's a listed thing, then obviously 50AA does not apply. It applies, so the question is, one can maybe argue that yes, it is listed over there, and so the 2 years and the 100 and the 12.5 is something which one can. There is also the thing that some clients we've seen investing in, real estate fund which are structured as a limited liability company. Under US federal laws, this is treated as a transparent entity. Just to the saying, I think one should treat that as a transparent thing from an Indian perspective as well. Though one will try and there have been people I've seen treated as capital gains and saying like as an investment company. And there is a set-off of a loss which is incurred by LLC has been allowed. There is a Delhi tribunal decision in the case of Rohit Kapoor, where they've considered this situation where there is an investment in the overseas LLC. Well, I think I've exceeded my time limit. Thank you very much for very patient hearing. I hope it's been useful.
Thank you, Gautam ji, for the wonderful session. Members will be lucky that Sir has touched upon each and every aspect of the capital gain, also overseas investment and derivatives. Thank you, sir, for sparing your valuable time. I request our past conveners here, Lalit Chandra Panchal ji, to give the hearty vote of thanks.
Thank you, Vishal. Good morning, everyone. It's an honor to extend a heartfelt vote of thanks to C. Gautam Nayak sir, our distinguished speaker, for an exceptionally insightful session on capital gain taxation on securities. Sir's clarity and the use of practical examples made complex issues much easier to grasp. The way he touched upon critical concerns and shared practical insights has truly enriched us all. We are grateful for your time, sir, and sharing your valuable knowledge and that has added value to our session today. I request everyone to carry out a huge round of applause for this. Thank you. We'll have a break for 20 minutes. Thank you.